All right. It is a beautiful Monday, made even more beautiful by the fact that I get to record your video lecture today as opposed to waiting till Thursday evening. I'm sure everyone's as excited as I am. Okay, let's get going. We're going to talk about corporate redemptions. And unlike last time, there is a part 1 and a part 2. But part 1 is this week and part 2 is next week. So we're going to slow down the pace here a little bit because in theory these things start to get a little more complicated. Okay, so let's review where we've been so far. So we've talked about this idea of creating a corporation where you contribute cash and property, and this understanding of, look, what the code is built to do is allow you to go in and out of organizational form and in theory not trigger any tax recognition, even where there's realization. And 351 is the code section and some of its compatriots that build a system that is trying to exclude some form of sale as opposed to the creation of a new organization. We certainly talked about operating the corporation, right, with respect to calculating taxable income and some of the unique characteristics that apply to the corporate form. And then we talked about sending that money back out to the owners through distributions, coming in the form of either a dividend or a return of capital or ultimately a gain. And now we're going to work on transfers of corporate ownership. And we're going to talk about things like the difference between selling to a third party and selling back to the corporation in a redemption, and then ultimately follow that up with liquidation, which is just a redemption on steroids. And then finally, when we're getting close to the end of this cycle, we'll talk about reorgs, but not this week and not next week. Okay. So let's talk about corporate organizations. So carryover basis for assets shifted into the corporation. There was a limit on built-in losses. 351 said services and certain forms of debt, but not typical debt and accrued interest were not treated as property. That assumption of liabilities was generally not treated as boot unless they were in excess of basis or there was something funky going on under 357B. And then 351 said there needed to be this control, right, in order for this to be something besides a sale. If you're entering into a business, then obviously you should be in control of that business when you're done, or else you sold whatever that property is to someone else, and the 80% rule. And then we talked about contributions of capital by shareholder were treated the same, carryover basis plus any gain. We talked about the differences between debt and equity, right? And some of the rules under Section 385, right? The form, the debt equity ratio, the intent, proportionality, and subordination of shareholder debt to outsider debt. These were all factors when we were trying to differentiate between whether that instrument is debt or whether that instrument is equity. And we talked about these distributions, first being a dividend, then being recovery of tax basis, and lastly, any amount above that was a capital gain. And we talked about how you define a dividend by a distribution coming out of earnings and profits, which were either accumulated or current earnings and profits. And when a corporation distributes its own property, so as opposed to cash, it could recognize income but no loss. That gain would get included in E&P, but then the distribution reduces E&P by the fair market value of that property. The fair market value of the distribution would be tested for dividend treatment like cash or any other distribution would be. And the tax basis to the shareholder for the property received is the fair market value. And again, if there's a distribution of lost property, there's no loss recognized. The fair market value of the property distributed would be a dividend to the extent of the E&P, and E&P would be reduced by the adjusted basis of the property, not by its fair market value. There were a handful of exclusions to the tax-free distribution of stock, and many of them related to shareholders having an option for cash versus stock, or it being disproportionate, the end game here being, for the most part, that to the extent there's a true change in ownership form, that's going to be a taxable distribution of stock, right? To the extent that it's proportionate and no one's ownership really changes, well, then it certainly just feels like a tax-exempt distribution of stock. And that leads us to our next way for shareholders to get their money out. So we know, we've already talked about this, they could pay salary, they could pay interest, they could pay rent, and those are all good options, salary less so. But of course, there has to be an actual transaction underlying that, right? You can't have your corporation pay you rent if you don't own something that it's renting. So you can sell your shares to a third party, right? We didn't really talk about that, but that's obviously always an option, right? If you want to get your value out of the corporation, you could just sell your shares to someone else, right? And in theory, they pay you the fair market value of those shares. That's capital gain treatment. That's good, right? Preferential rates for individuals. And on top of that, you, of course, get to reflect the adjusted basis as a portion of the proceeds that you get back tax exempt. So the downside is, of course, you no longer own those shares, and you may lose your right to control that particular activity or entity. You can take a distribution of cash or property, but we see now that comes out as a dividend. There's no deduction to the corporation. Really lends itself to the double taxation that's part of corporate holdings. And to the extent it's property, the corporation has to recognize a gain anyway. And so you really get double taxed no matter what. Okay, so let's start with a hypothetical example. And in this particular example, we have Natalie. And Natalie owns 100% of Value Corp. She owns the whole thing. And Value Corp has had lots of historical profits, and it has lots and lots of E&P. And she's been rolling all that money back into the corporation for years and years. And now she's ready to start enjoying the fruits of her labor. But like most taxpayers, Natalie despises double taxation. So she looks at paying herself a salary, and she says, oh, employment taxes will crush me. She looks at paying herself a distribution, and she says, oh my God, double taxation, that'll crush me. She says, oh, I could sell some of my stock to a third party, and she says, I'm not prepared to give up control of this great thing that I've built. It's my baby. So she says, look, all of these suck. So she needs to come up with a new strategy, and her new strategy is, well, wait a second. Why doesn't she just sell some of her stock back to the corporation itself? So in this instance, she owns 1,000 shares of Value Corp. That's 100% of it. Her basis in those shares is $200,000 or $200 a share. Current value of that stock is $500 per share. If she wants $200,000 of cash, then she could pay herself that dividend, but then she'd have to pay tax on it. Or she could have the corporation buy back 400 of her shares at fair market value. Therefore, the corporation would pay her $200,000. She'd be lighter by 400 shares. You treat that as a sale of her shares, so her amount realized $200,000, her adjusted basis $80,000. So her gain is only $120,000 times 15%, or only $18,000 of tax. And as a result, she ends up with $182,000 in her pocket. So without really doing anything but changing the form of this distribution, she ends up saving $12,000, $170 versus $182. This is a pretty good plan. Nicole, on the other hand, is one of 3 founders in her company called Growth Corp. And she's the same thing. Growth Corp has been kicking butt, lots of profitability. She owns 33 of the stock, a third of the stock, but she's now ready to retire. She's ready to just be done. And she gets it. The other 2 owners want to continue to operate Growth. And unfortunately, because they also have been rolling all the proceeds back into the corporation, they really don't have the cash to acquire Nicole's shares. So again, same thing. Why not just let the corporation acquire those shares? So what would happen is ownership would stay with the remaining shareholders, and now Nicole just gracefully exits the corporation. So in scenario one, when we talked about Natalie, that should have felt like dividends in disguise, right? So let's see, there was no fundamental change in ownership structure. She owned 100% before, she owned 100% after. All that really happened is the corporation distributed $200,000 to her and she gave them some pieces of paper. Dividend treatment might seem correct in those circumstances. In scenario two with Nicole, well, that feels really more like a sale, right? I mean, she's out of the business now. There's been a significant change in ownership structure, especially with respect to her. She owned a third and now she's going to own zero. And so as a result, that feels like a sale. And when you have a sale, then recovery of basis seems appropriate. So we need to be able, or the tax law needs to be able to draw a line in the sand, right? So where do we draw a line between Natalie and Nicole so that Natalie doesn't get sale treatment and Nicole does get sale treatment? And I can tell you that the code is going to focus on the issue of change in ownership, right? And they're going to be particularly concerned with Natalie owning 100 before and after the transaction. And they're going to be considerably less concerned with Nicole, who owned a third beforehand, but now owns zero afterward. So let's think about how this would affect different types of shareholders. So an individual shareholder is almost always going to prefer sale treatment. Dividends are taxable to them, and they get to reduce the amount realized by their adjusted basis. Whereas a corporate shareholder could very well prefer dividend treatment. And they're likely to prefer dividend treatment because they can offset the dividend with a DRD, depending on the percent ownership. So, we have two different types of shareholders that have competing and opposite interests in how a particular transaction might be treated. So we need to understand that when we're going in, because we're going to talk about this from the perspective of an individual shareholder, but the reality is it could be a corporate shareholder too. Okay, so a qualified redemption gets sale treatment, and a non-qualified redemption is probably going to be a dividend, but what would happen is it would be subjected to the E&P test, right? So to the extent there's a non-qualified redemption, you'd examine the property and cash that was distributed. Did it come from E&P? If so, it's a dividend. If not, then it's a return of capital and then capital gain. Okay, so Section 317B covers redemptions, and it describes it as a corporation's acquisition of its own stock in exchange for property, and that's irrespective of whether the stock is canceled, retired, or held as treasury stock. So this is basically a corporation buying back its own stock. 302 says that a redemption shall be treated as a distribution in part or full payment in exchange for the stock if the transaction fits any of the following categories. So 302 rides along and says, here's how you're going to get gain treatment. So first, you meet the substantially disproportionate redemption test. And this is clearly exactly what it is. It's very much a mechanical test. Number two, a redemption of all of the shareholder stock. So we call that a complete termination. So for example, Nicole had a complete termination. Number three is a partial liquidation. We'll talk about that more next week. Number four is a redemption that is not essentially equivalent to a dividend. These are very subjective rules. And then number five is a redemption by a publicly regulated investment company. And we're just not going to spend any time on that at all, although it may come up when I have a guest speaker come in and talk about REITs, real estate investment trusts, because I suspect that REITs have a similar problem with redemptions that RICs do, or mutual funds. Okay. So a redemption qualifies under this mechanical test, this mechanical substantially disproportionate redemption test, if it meets the following three requirements. Number one is immediately after the redemption, the shareholder must own less than 50% of the total combined voting power of all classes of voting stock. Number two, the shareholder's percentage ownership of voting stock after the redemption must be less than 80% of their ownership of voting stock immediately before the redemption, and the shareholders' percentage ownership of common stock, whether it's voting or non-voting after the redemption, must be less than 80% of the same percentage immediately beforehand. So think of 1 as being the 50% test, and 2 and 3 are often combined to be a single 80% test. So it's clear that 50% is organized around the notion that if you own more than 50%, you have control over the corporation because no one else can outweigh your vote. And the second one, those two congeal into a single test if there's only one class of stock outstanding, if there's only common stock. So, and the idea is, look, we're looking for a substantial contraction or a substantial change in ownership, which is being defined as 20%. Okay, so here's our example. We have a shareholder. That shareholder has a 60% ownership represented by 60 of 100 shares of the outstanding voting shares. And the corporation is going to buy back 25 of those shares from the shareholder. It's going to pay him cash. Let's see how that's treated under the substantially disproportionate test. Okay, so when we look before the redemption, the individual shareholder owns 60 shares out of 100, or 60%. When 25 of those shares are redeemed, the individual shareholder now owns 35 of the total of only 75 shares, which is now down to 46.67% ownership. That's 35 divided by 75 is 46 2/3, which means that we clearly meet prong 1 of the substantially disproportionate test. The shareholder's percentage of ownership of voting stock immediately after the redemption must also be less than 80% of the same percentage immediately beforehand. So when we look and we say, okay, what was ownership beforehand? It was 60%. So the ownership now must be less than 80% of that 60%. So because ownership is 46.67, that is less than 48%, which is 80% of 60%, then this, in fact, does meet the substantially disproportionate test and would get sale treatment under 302. Because there's only one class of stock, the test that applied in 2 applies to 3, and it's all good. All right, let's do another example. Now we have Corporation M, 400 shares outstanding. A, B, C, and D each own 100 shares, so they each own 25%. And M is going to redeem 55 shares from A, 25 shares from B, and 20 shares from C. So you can see that I've calculated before redemption, the redemption itself for each shareholder, and then what does the ownership look like after the redemption. So if we look after the redemption, A, B, and C all own less than 50%, right? So you'd say, okay, well, none of them are in control. But think about it. None of them previously owned 50%, which is one of the reasons there's a second test, this 80% ownership change, because you can see that you could have had a very simple pro rata change and everyone would have had less than 50% because they all started with less than 50%. Okay, so let's go to part 2, the 80% test. So who has 80% less than they had before they started? So let's see, A's ownership went from 25 to 15, B's went from 25 to 25, and C's, believe it or not, actually went up from 25 to 26 2/3. And of course, D's also went up from 25 to 1/3. So the only one of these who has less than 80% of what they had beforehand. So what is 80% of 25, right? So that's 20. So they would have to own less than 20%. The only one that meets that test is A. So A has less than 20%. As a result, this is a redemption to A, but it would be a dividend distribution to the extent of E and P to B and C. Okay, so what if just subsequent to this, so the prior transaction's done, and now there's a redemption of 75 shares from D. So D was late to the game, obviously. So we look at the additional redemption of 75 shares away from D. Their ownership is now dropped to 11%. So there's no doubt in my mind that first off, they own less than 50%. Secondly, the redemption is a reduction of more than 20%, or another way of saying they own less than 80% of what they used to own. As a result, D's qualifies as a redemption. What if, however, the service came along and applied the step transaction and said, wait a second, these were interrelated redemptions. It's not fair for you to parse these out separately. Well, in this case, we would put all of them together as a single redemption. So you can see under the redemption, we've got the 55, 25, 20, and 75 shares all coming out. Again, they're all going to meet the 50% test because largely they all met the 50% test beforehand. But now the only shareholder that will receive redemption treatment under the 80% test is D. D went from 25 to 11%, and you can see that the others did not crest the 20% mark in the D. In fact, two of them went up. And so as a result, only D would enjoy redemption treatment, and poor A gets screwed. Okay. So you can see that whether a redemption qualifies as an exchange depends on the magnitude of the reduction and the shareholder's stock ownership. And so one of the things that taxpayers, as you can imagine, would have done very quickly is they would have said, oh, okay, well, what I'm going to do is give them some of my shares to my wife, and then some of my shares to my kids, and then some of my shares to my grandparents. And so that when you measure my ownership as a single owner individually, you could qualify for redemption treatment. But the reality is, all those shares were just in the hands of your family. And so as a result, when you do a redemption, you have to invoke the constructive stock ownership rules of 318. So they call these the stock attribution rules, and they are confusing. And we're going to walk through a bunch of examples to try to give a better understanding of how they work. But note that obviously the notion here is that to the extent stock is attributed to other family members, there's a pretty good chance it's going to reduce the possibility of a qualified redemption in a closely held family corporation. Okay, so there are four types of constructive ownership or stock affiliation in 318. There's family attribution, which treats stock owned by one family member as constructively owned by others. There's stock owned by an entity, for example, a partnership, estate, trust, or corporation, that's going to be attributed up to, at least loosely speaking, its owners, be they partners, beneficiaries, or shareholders. Moving in the opposite direction, 318 attributes stock ownership from owners down into the entities they own. So think of it as attribution up and attribution down. And then the owner of an option to acquire stock is treated as constructively owning the underlying stock. Okay, so let's talk about these family attribution rules, right? So under family, an individual is deemed to own the stock owned by his or her spouse, children, grandchildren, and parents. Note that that does not include siblings or grandparents. If a partnership owns stock, the partner is deemed to own the stock that is owned by the partnership to the extent of their proportionate interest in the partnership. Stock owned by a partner is deemed to be owned in full by the partnership. So that's the attribution up to the owner and then the attribution down to the entity. The same rule basically applies for estate and trust. The beneficiary or heir is deemed to own the stock owned by an estate or trust to the extent of their proportionate interest. And then stock owned by a beneficiary or heir is deemed to be owned in full by the estate or trust. So those rules pattern very closely the partnership rules. Corporation is slightly different. So stock owned by a corporation is deemed to be owned proportionally by any shareholder owning 50% or more. So this is good news because otherwise, if you own shares in a public corporation, and even if you only own just a few shares, you might have attribution problems because that corporation may own all sorts of investments and you don't even know what they are. So in any event, it's only if you own more than 50% do you have to worry about attribution. And then going the other direction, Stock owned by a shareholder who owns 50% more of a corporation is deemed to be owned in full by that corporation. Okay, so if you like visual images, here's a cool visual image. You can see the family attribution rules are in pink between the taxpayer, the spouse, the parents, the children, and grandchildren. And in between entities, you can see that attribution to the entity is 100% of what the taxpayer owns. And then coming from the entity, it's pro rata share. And that only applies to corporations if there's 50% or more ownership. All right. So there are some restraints to reattribution. The first is known as double family reattribution. So, for example, parent to child attribution, yes, we know that exists. It was on the chart we just looked at. But parent to a child and then to the child's spouse, that's considered double family attribution and is not prohibited, or is prohibited, is not permitted by the tax code. So the child's spouse would not need to include their in-laws' parents' stock ownership in their own. And in sideways attribution, we know from partner to partnership, but would it go partner to partnership, then back down to a different partner? And the answer is no. That's known as sideways attribution, and it also does not apply. All right, let's do a great example. So all 100 shares of X Corporation are owned by Partnership P. Partnership P has 4 partners that are all unrelated. A, B, C, and D, and each own a quarter. A is, of course, married to W. That's A's wife. We've got M, who is W's mother. And as it turns out, W, A's wife, owns 100% of the shares of Y Corp. So Y Corp is a wholly owned corporation by W or A's wife. Okay, so we've set the ground stage. Let's see where we're going to go. How many shares, if any, of X are owned by A, W, and M? So that's how many shares are owned by A, how many are owned by A's spouse, W, how many are owned by A's mother-in-law, M. Well, let's see if we can figure that out. Okay, so A owns 25 shares of X by attribution from the partnership. So again, the two entities, they're going to share because they're solely owned with each other. Whatever X owns, P owns. In this case, P owns 100% of X. So therefore, A, as a 25% holder of P, has 25% of that ownership attributed up to them. That's an upward attribution from the entity to the individual. A attributes all of his stock to his wife, W. So W owns 25 shares of X through family attribution. However, M doesn't own any shares of X because that would be double attribution from A to W and then W to M, and the rules do not permit that. Okay, so how many shares, if any, of X are owned by Y? And would Y constructively own any shares of X if W owned only 10% of Y? So let's deal with the first question first. Okay, so how much of X is Y going to get tagged with owning? So we've already followed the chain that A owns 25 shares, W therefore owns 25 shares. So how much of that gets attributed up to Y Corp? Well, because Y owns 100% of all of Y's stock, then all of it is going to be attributed up. So Y constructively owns 25 of the shares owned by W. Since W owns 50% or more of the value of Y stock, all of the stock owned by a 50% or more shareholder is attributed to the corporation. If, on the other hand, Y owned only 10% of Y, W only owned 10% of Y, then none of those X shares would be attributed up to Y because W is no longer a 50% shareholder. So you might need to pause and think about that one for a little bit. Okay, so how many shares, if any, of Y, this is of Y, are owned by P, B, C, D, and X? So we've got Y down at the bottom, and we need to figure out how much of Y is owned upstream through the wife, through the husband, and then through the partnership in X Corp. Okay, so P constructively owns 100 shares in Y. So let's think about why that is the case. First, all of those shares are attributed to W because W is greater than 50% owner in Y Corp, and she owns all of those shares. So then A is attributed all of W shares. And then the attribution downward from A to partnership is 100%. So we ignore the pro rata share in that direction. And as a result, P owns 100 shares of Y. Okay, now we can consider B, C, and D. B, C, and D actually own no shares of Y. Because remember, that's going to require some sort of, because they're unrelated, we know the family double attribution rules don't apply. But we do know that the second type of attribution, where you go up and then back down, the sideways attribution also cannot apply. As a result, B, C, and D own none of the shares of Y. However, because P owns 100 shares of Y, and X Corp owns 100 shares of P, or sorry, P owns 100 shares of X, all of those are attributed downward to X Corporation. As a result, X owns the same 100 shares that's owned by P. Okay, so let's look one more time. Let's break down these family attribution rules because these are the ones that are frequently trapped for taxpayers. So again, an individual is deemed to own stock owned by spouse, children, grandchildren, and grandparents. Okay, so let's start with dad. What does dad own? Well, dad owns anything that mom, son, or grandchild own because all of those are going to be attributed to dad. All right, what about mom? What would mom own? Well, mom's going to get everything attributed to dad as spouse and son and grandchild, just like dad did. So mom is attributed ownership of stock by all of the other three parties. All right, what does son own? Well, again, if you're deemed to own the stock of your spouse, children, grandchildren, and parents, then son also owns everything that all those other parties own. What does grandchild own? So remember, we have spouse, children, grandchildren, and parents, but we do not have grandparents. And since dad and mom would be the grandparents of the grandchild, none of their stock is attributed to the grandchild. Okay, let's replace dad with grandma. So what we've done is we've introduced another element, another chain in the dimension of this family. What does grandma own? I don't know about grandma, but grandma is going to own anything owned by her spouse, children, grandchildren, and parents, which stops right there. So whatever the grandchild owns, which by the way would be grandma's great grandchild, is not attributed up to grandma. Now, if grandchild had a brother, then no stock would be attributed to grandchild, from grandchild to B through the son, right? So let's make sure we understand this. If grandchild had a brother, then that would mean that son had another son. So he would have two kids, one would be grandchild, one would be brother. We're not going to do a double attribution between those two because that's what that would require. Okay, so let's do some quick attribution and redemption work, and then we're almost done with this video. I'm sure you're pleased. Harry owns 40 shares of Mr. Zero Corp. Sally, Harry's wife, owns 10 shares, and Phil, an unrelated party, owns 50 shares. So if Mr. Zero Corp redeems 23 of Harry's shares and 2 of Sally's shares, let's look and see what happens. Okay, so you can see we've got Harry and Sally separately. There's the 23 and 2 shares being redeemed. But we need to look at them in total because their shares are attributed to each other. So whatever Harry is, that's Sally too. Whatever Sally is, that's Harry also. So when we look after the redemption, we need to see if they pass the 50% test. And sure enough, they do. So after the redemption, Harry and Sally now only own a third of Mr. Zero Corp, and therefore they pass the 50% test. Now, how about the 80% test? The 80% test shows that just Harry is less than 32%. That's what he needed to get under, and he did. Just Sally needed to get under 8%. She did not. But collectively, they both get under 40%. And as a result, this would qualify as a redemption even after stock attribution. So there are a few times when you can waive family attribution. The one is for redemption in a complete termination. So if someone's getting rid of all their ownership shares, you can waive the family attribution rules. The second one is they don't apply to partial liquidations or redemptions when they're used to pay death taxes. Okay, that brings us to the end of part 1 and everything we're going to cover in the slides for this week. So we'll do an in-class exercise. If you care to guess, it's going to be on redemptions. Thanks for watching.